Hello, my name is Peter Young, and this is the third of a three-part series of interviews I'm conducting on a book called The Zero Interest Trap, which focuses on the phenomenon of 0% interest rates that we've observed around the world since the 2008 financial crisis. And I'm joined today by one of the co-authors of that book, Gregor Hochreiter. Gregor is the editor-in-chief of the annually published Ingoldsby Trust Report, which is one of the most widely read gold reports in the world. And he's also the author of 3 books on economic issues and works as an independent economist. And in today's interview, we're going to be having a discussion around some of the economic theory regarding 0% interest rates, and also focusing on how this applies specifically to the European banking system. So welcome, Gregor. It's great to be having the conversation with you today.
Thank you, Peter, for having me, and thank you for the kind introduction.
Great. So I wanted to talk off, Gregor, by talking about the environment we find ourselves in 2021 and how that compares to other periods in history. Because at the moment we have very low interest rates, as we referenced. Since 2008, central banks have worked to push them down to 0% or near to that level. But we haven't seen very high levels of inflation, and that's surprised many commentators. And if you look back at history, for example, the last period that there was widespread stagflation taking place across Western economies in the 1970s and early 1980s, we had higher interest rates, and we didn't necessarily see extremely high levels of government spending at that time. So it'd be great if you could give us a bit of a view as to why it was that in the 1970s and 80s, there was such high and noticeable consumer price inflation, and why today we've seen below target levels of inflation and less of that kind of activity that indicates there's going to be inflationary pressure.
Yeah, that is one of the questions which is increasingly debated nowadays as CPI rates are picking up both in the US and also in Europe, and one has to say in certain countries in the European Union. But the main issue is that if you speak of inflation, we usually mean inflation in prices. And to be more specifically, prices of consumer goods and services, so not of prices of financial assets or housing prices. So the main reason is that the increase of the money supply is a necessary condition for price inflation to happen, but not a sufficient condition. So this additional money has to flow into consumer goods and prices in order to increase the CPI or PCE or any other inflation index. And this has not happened in the last 10 to 12 years, more so in the European Eurozone, less so in the United States. And the reason is, or there's a debate, what has caused this. One hypothesis is that because of aging, people save more, so they spend less nowadays on consumer goods and services to have savings when they retire. Another reason is that due to for the fall of the, that is not only a theory, this is something which is which is common knowledge, that because of the fall of the Berlin Wall and especially the integration of China into the global economy, on the supply side, there was a massive expansion of supply, which of course has a downward pressure on prices, but also on wages, for example. And that happened since 1989 with a certain acceleration starting in the late 90s, when these economies really started to pick up. And of course, they could, for example, the workers from the Eastern European countries could move into or could work in the Western Europe. Yeah, and if we go to the Corona crisis or to the situation nowadays, so in the last year since the Corona pandemic has dominated monetary and economic policy decision. One has to say that the savings ratio has increased dramatically. So while the central banks have dramatically increased the money supply, the base money supply, people almost doubled their savings ratio. One reason is forced savings, which must not be confused with forced savings in the Hayeken sense, but simply because people could not spend the additional money because shops are closed, you cannot travel, so you simply don't spend the money. You cannot go to the coffee house or have a beer in a pub. And the second one is precautionary saving. So people are saving because the insecurity has increased dramatically. People don't know whether they will have work in the coming months or years to come. And so they increase their savings. And this has, of course, had a downward pressure on the CPI.
Yeah, thanks, Gregor. It's really important to appreciate the dynamics of global trade in all of this. I mean, I've just spent 10 years living in China, and the scale of what's happening there is really incredible. And much of China's development has been focused on export-oriented manufacturing. And you have to remember that all of that new production, which really wasn't there during the time that China was under a very strictly communist regime, is suddenly passed on to the global market, and that brings down costs in other ways. So it's important to bear in mind that there are all of these geopolitical factors that influence that headline figure of CPI that we focus so much on in the West. So why is it, Gregor, do you think that politicians at the moment are so focused on keeping the CPI low? Because we've had, particularly around the time of the 2008 financial crisis, there were great fears about deflation, and that was deemed to be a worry. And there's still controversy about what happened there. Clearly, we undertook some quite extreme monetary measures in order to reinflate the economy. And some people have argued that that was the wrong thing to do, that there perhaps shouldn't have been a complete laissez-faire approach, but we should have allowed more deflation to have happened in order to allow the economy to readjust. So why do you think it is, Gregor, that politicians are so keen to avoid deflation? Because surely there would be some good aspects for economic readjustment in the long term if we were to have a bit of a cleansing of some of the businesses that are less productive in the economy.
I think there are two reasons. One, a deflation would increase the real debt burden, and especially those countries which are highly indebted, for example, the United States, or in Europe, Italy, Greece, or France, would see increasing problems to service the debt. And secondly, this fear is more prominent among central bankers and economists, that if you allow deflation to happen, the entire economy would move into a vicious circle. So there would be a never-ending downward spiral to ever more deflation, which would lead to a collapse of the economy. This is an deflation phobia, to say the least, is definitely exaggerated, but it defines and influences the approaches of central bankers, economists, and politicians. Central bankers and economists, whereas the fear of the politicians that real debt levels will increase has something to it. And another aspect would be that, of course, as a politicians, you strive for re-election, and a deflation, at least in the beginning, would coincide with negative growth rates because the recession is a kind of the healing phase for the economy. And of course, if you run for elections, you don't want the economy to be stalling, even if it's just a short time correction. So you pump up everything in order to be re-elected, because good economic data increases your probability to get re-elected. As I think it was Bill Clinton, or the advice to Bill Clinton said, it's the economy stupid. Of course, there's certain other topics which are relevant as well, but of course, with high unemployment, you are less likely to win elections than with low in an environment with low unemployment.
Mm. It's interesting, this idea of deflation and the theories around it. One of the things that I've been thinking about is the fact that when people talk about this cycle that you reference, this vicious downward cycle of deflation, they often think about the price level as being one thing, one fixed thing that's somehow measurable via an index. But of course, if you have deflation taking place, then that brings about bankruptcies of less productive businesses. And when a bankruptcy occurs, two things happen. Firstly, that business stops producing, which decreases the supply of consumer goods. And secondly, the assets that that company has are put back onto the market because they're sold off in order to meet the obligations of the bankrupt company. So you have a decrease in supply of consumer goods and you have an increase in supply of the capital goods. So what entrepreneurs care about is being able to make a profit. So what the disparity is between the consumer goods that they're able to sell at the end of the production process, and also the disparity between those and the costs of production, the costs of buying capital equipment or labor. So isn't it the case that even if you have deflation, because the price of capital goods falls so much quicker than consumer goods, then that stops the deflationary cycle. You have that profitability reestablished again, and entrepreneurs can then go out there and it becomes profitable for them to reinvest. So is there something wrong with that argument, or do you think that's a fair description of what happens in deflation?
No, I think it's a fair description, even though it's just one side. And as almost always as in economics, especially when it comes to economic policy, there are two sides to every coin. One must not forget that in a monetary economy, almost everybody is dependent on monetary income. So, and if you don't have any savings, you become unemployed, then you have a problem of even buying everyday goods. So that this is completely different to an agricultural society where you at least could till your own soil. I mean, have a little bit of simplified romantic interpretation of an agricultural society, but at least you can provide to a certain amount for yourself. And in a monetary economy, which is based and enables the division of labor, this is one aspect one has to bear in mind. So even now, it was, I think it was the correct answer of governments to support incomes or even the the structure of the economy with massive subsidies and other additional expenditures in order to prevent this negative effect, as many people would suffer if they don't have continuous income streams. But of course, this must not prevent the adaptation of the economy completely. Otherwise, you get what has now found its way already into mainstream economics, this zombification of the economy. The Bank for International Settlement is reporting on that issue regularly. So we need also structural adaptations, but of course one has to bear in mind this, let's name it social aspect in a monetary economy, which of course is just a minor aspect, but which has to be bear in mind.
Mm. So you mentioned there zombie economies. This is something I touched on a bit with Raheem yesterday. What could you just give us a simple definition of the term zombie company and why that is so common when you have a 0% interest rate environment?
Yeah, a zombie economy, zombie company is defined, there are various definitions, but it's usually defined as a company which can only survive because of the low interest, artificial low interest environment. So with higher interest rates, this company would not be able to service its debt. So this company is only alive because of the artificial lowering of the interest rate. And these companies, as you mentioned earlier, they need they have capital goods they use which cannot be freed then, or which are then not freed for other new companies. And as a consequence, the economic structure is getting more and more rigid. So in the medium and long term, this zombification should lead to lower economic growth. Sooner or later, you have to allow for this adaptation of the economic structure. The longer you prolong, the longer you extend this adaptation to the future, the more extreme will be the need for adaptation, or the less economic growth you will have, or even a negative growth. I mean, that was one of the main reasons why socialism failed, because in the end, they did not produce anything anymore. And then, of course, you go bankrupt, not only as a single company, but as an economy as a whole, which, of course, is much worse. So I think we have to deal with this trade-off to let certain companies go bankrupt in order for the entire system to stay afloat. The alternative is not that there will be no bankruptcies. The alternative is there will be the bankruptcy of the entire economy, which is much, much worse for everyone.
Yeah. Yeah, there tends to be this stigma around bankruptcies because clearly in the short term, they're painful things for the people involved with them to go through. But of course, the whole concept of creative destruction is that in order for there to be resources free to go to meet the real needs of consumers, some businesses need to either adapt or they need to be dissolved entirely. So these things are kind of viewed as healthy in the Austrian economic framework. But generally, there's a perception that bankruptcies need to be prevented at all costs. And it's important to consider these effects that you reference when thinking about that.
In the current situation, we must bear in mind that bankruptcies in 2020 have been at an historic low. And especially if you compare this development to the developments after or during the great financial crisis, we have a massive, there's a significant number of companies which will go bankrupt as soon as they are allowed to go bankrupt, because there are now certain moratoria. And this will be one of the major economic challenges in the months and years to come. I mean, it's, and also psychologically, this will be a challenge because people will think that the corona pandemic is over, which at a certain point it will be from a medical point of view, but of course not the economic or other social consequences. So I think it would be wrong to make people believe that, let's say in autumn or in winter, everything is back to normal. I think then the economic consequences will be have to be dealt with in sincerity, and this will for many people be more burdensome than they nowadays think.
So another thing I wanted to ask you about, Gregor, is the banking system itself. So we've touched a bit on the kind of real economy and the different sorts of businesses and how that might need to readjust going forward. But in terms of the actual banks themselves, can you explain a bit why the 0% interest rate environment creates a special pressure on the traditional model of banking, whereby you tend to make profit on the spread between what you lend and what you borrow as a bank?
Yeah, the main reason is that the margin for commercial banks shrinks as you have the zero lower bound, or even commercial banks get now a negative interest on the deposit facility. And additionally, banks are faced with a tremendous change in their business model as thanks to the internet, most of your business or most of the banking business can now be done using the internet. So in a digital way, you don't have to go to a bank anymore to pay in money or to make a transfer. You simply do it, or even via your mobile phone. So so banks are now faced with 2 or 3 developments at the same time. And for example, if you plot the deposit facility in Europe, in the Eurozone, with the Eurostoxx banking index, you really see how they go hand in hand together. And now we have negative rates, and the banking or Eurostoxx banking index is significantly lower than years ago. But one has to say that the European banking system is in worse condition than the American one, which could also be a result of the fact that the United States is much more dependent on the financial markets on this side. On the other hand, Europe is more dependent on banks for financing businesses. So this could, in the medium term, become a severe problem also for the economy. And Europe, which excludes, of course, the United Kingdom, relies traditionally much more on the banks than on the capital market.
Yeah, that's something that was referenced in your book, that there are many more loans from banks going to support businesses than there are in the US. Can you just explain a bit why that whole phenomenon came about?
Well, that's a very good question. I think, at least speaking for Germany and Austria, we are much more risk averse than the Anglo-Saxon world. So, I mean, you have the bank as an institution, which is considered as a kind of a branch of the government, in the sense that there will always be banks, at least for the last 150 years and the years to come. And we have less, we are much more risk averse. So we maybe see more the risk and not the chances of some investments. So we want to prefer to have lower interest rates or lower profits, but they are more secure. So maybe that's one reason why we, the Germans and the Austrians, and actually the rest of the European Union relies more on the banking sector. And also historically, of course, many the governments have been much more important for supporting and controlling the economy than in the Anglo-Saxon world, which does not mean that, especially in the United Kingdom, there were also the governments intervened in some decades severely into the economy. But for us, it's more a cultural thing. It's an ordinary thing and not something we just draw on in crisis. But typically, Germans and Austrians are more eager to lend trust to institutions and not so much to individuals, I would say. Maybe. But that's a cultural question.
Yeah, it's interesting to examine the differences in the financial system in the UK, European Union, and in the US. in the book, you focus quite a lot on what's happening specifically within the European financial system. And there's a lot of quite complicated things to consider regarding just the plumbing of that whole system and how it works. And you've highlighted a few specific risks. One of those relates to the Target 2 system, which is the mechanism through which individual national banks undertake transactions for clearing trade between different countries within the European Union. Can you just tell us a bit more about Target 2 and why you've flagged that there could be some risks related to that system within the European system?
There was an intense debate especially in Germany, on how to assess the Target 2 surplus or deficits, and one of the main, or one of the first economists to raise this issue was Hans-Werner Sinn, who argued that the Target 2 surplus of Germany could, in the case of a breakup or of the Eurozone, or to be more specific, in case that one country, and everybody was thinking about Italy, leaving the Eurozone, lead to the fact that Germany would have to would lose their claims on the Target 2 system. Germany now has a claim of more than €1 billion on the Target 2 system. So we're speaking about a quite significant sum of money. And the debate was whether these claims are really claims or just the result of or just a consequence of the decentralized nature of the Euro system. So basically, while the European Central Bank is responsible for drafting the monetary policy, it's the national central banks which are in charge of realizing this monetary policy. And this dualism of a centralized European Central Bank with decentralized national central banks leads to the fact that the settlement of the cross-border flows is not done centrally, but via the European Central Bank. But my position was always that the differences between, let's say, the camp of Hans-Werner Sinn and his critics was not that much. There were some technical differences, but the main difference was whether one country leaving the Eurozone is a realistic scenario or not. I think that was the main difference. And even the Deutsche Bundesbank in their annual report of 2011 stated that there would be a risk in case a country leaves the European Union, but they don't deem this where they rather expect the Eurozone to remain complete. So that was more a political, was more a question of whether the Eurozone will remain intact or not. Hans-Werner Sinn and his successor at the IFO Institute, which is based in Munich, Professor Füst, they added later on the scenario that if one national central bank would go bankrupt, and they were speaking of the Banca d'Italia, or thinking of the Banca d'Italia, that would also lead would also have the consequence that Germany would have losses because their claims on the Target 2 system would diminish in the amount of Italy's deficit minus its claims on the Eurozone. So the main question is whether Italy will stay in the Eurozone or not. And that is in the end a political question. So if you want the Eurozone to stay intact, of course, those in favor of this scenario will do whatever it takes to keep the Eurozone intact.
Okay, so is this a correct description of how it works? So rather than having individual commercial banks having accounts at the ECB, they have accounts at their national banks. So you've got the Banca d'Italia, who has got all the Italian banks as members, and when they transact individually, then they clear through the Italian bank, which has got its holdings denominated in euros, but it kind of manages all the banks within the Italian economy. And then you've got the same setup in Germany and France. And when you have lots of Italian companies trading through their banks with German companies, they, rather than going directly through the ECB, they go through their own national bank. And then the national bank ends up accruing relative deficits or surpluses with other national banks. So what sort of happened with countries like Italy that receive a lot of exports from countries like Germany is that you've got this big build-up at the national bank level where the Germans are running a very big surplus, which means that they're owed a lot of money by the Italians. And if the Italians, for some reason, were to leave the European Union, the idea would be that they would kind of default on this debt, and the Germans would basically have ended up exporting all of these real goods and services, but not getting paid for them in the long term. Is that a fair description of what's going on?
Yeah, that's a fair description. Of course, there are certain aspects like capital flight as well, which play a role. For example, when Greece was in turmoil, then you also have an effect on the target 2 or within the target 2 system. And again, the question is, if the Eurozone will never break up, then of course you can have these imbalances and there's no major reason to worry. Or you would say that maybe in 20, 30 years, things will change and Italy might run a surplus vis-a-vis Germany for what reason ever. But one must not forget that within Germany, for example, Bavaria is now a net contributor to the German federal budget. And I think 40 years ago, it was a net recipient. So things change over time. But of course, if you default on your obligations, then somebody has to pay the bill or has to loses his claims.
Okay, so can you talk a bit more widely? I mean, outside of Target 2, what do you see as being some of the main tensions, some of the main dynamics between the different nations of Europe that are within the Eurozone? And what kind of risks do you see on the horizon, particularly risks that have been exacerbated by this environment of 0% interest rates?
One must not forget that it was the idea of those politicians favoring the introduction of the euro that a common currency would lead to a political union, but also would lead to a common European economic culture, which means that the difference between those countries favoring a strong country, which was the old German D-Mark bloc, for example, with the Netherlands, Austria, or Denmark, and the southern countries, which typically favor higher inflation, would kind of merge into a one European common understanding of what a prop or how high an inflation rate should be, whether you should favor budgetary surpluses or deficits. But this has not happened at all. So quite in contrast, we see that the tensions between the old Denmark bloc and the southern countries actually increase, especially in times of crisis. So instead that in times of crisis, the countries would work together, you have the different opinions on how to conduct economic or monetary policy along the old lines. And we can, for example, expect that when in Germany the inflation rate will surpass the 2% mark, which could already be in 2 or 3 months, that in Germany we'll start to have a debate on increasing the interest rates in the Eurozone or reducing the various extraordinary measures like the bond purchase programs. Whereas Italy and France, which France is of course politically more a heavyweight than Italy, will be completely against it. So I think the political aim of establishing a common European economic culture has not been achieved at all. And we will see in the next 2 to 3 years whether the Eurozone will be kept together. I mean, the political will is there to keep it together, but of course the question is whether these politicians are also willing to pay the bill. Respectively, the voters will be willing to support these politicians at the elections. And we must not forget that Germany has general elections in September. So I assume that this could be even one of the main topics of the campaigns, or at least the campaigns of the AfD, maybe also of the Liberal Party of the FDP, so the classical Liberal Party, the FDP, and some groups within the CDU. I think we will see a return of the exact same debates we had during the crisis 2012 in Greece and then later on in Cyprus.
Mm. So broadly speaking, would you say that the reason why countries like France are more prone to inflation, like are fans of inflation versus deflation, is because they have more outstanding debt and they run more deficits than countries like Germany? Because obviously if you're Germany and you're owed lots of euros by everyone else, then if you have an environment of inflation, the real value of that, what you're paid back is lower. So is that roughly speaking the dynamic that you think is determining these differences within Europe?
Yes, but I think it's also there's also a cultural dimension to it. For example, in Germany and Austria, trade unions knew that an appreciating currency is also to the benefit of the workers. So it was in Austria. I mean, it's quite surprising the trade unions in the 70s who were in favor of a hard currency policy, while the industry favored a depreciating shilling because they thought, or it was their opinion, that this would foster exports and thus the profits of the industry. So if you take a closer look, it's not that straightforward, or sometimes you are surprised by who is favoring what and for what reason. But it's simply a way of approaching basic economic problems. I mean, you can have the approach of France and Italy to devalue your currency, to solve your structural problems by devaluing the currency. I mean, that's not what I would prefer, but I mean, it's an option, or it's a road you can take if people accept the consequences like higher inflation. So I think it's much more than just the question of the indebtedness of a country, even though this has a significant influence. But if you take a longer term view, there's a cultural dimension to it, which is quite often overlooked and leads to jumping to conclusions which are then, at least I would not say not wrong, but maybe not fully correct.
Mm. So you mentioned there the differences in culture between different European states. I talked to Raheem yesterday about culture in general and the way in which low interest rates start to have an effect on the culture over a longer period of time. So obviously there is in a normal market-driven system, you would expect significantly positive interest rates, and therefore there's an incentive for individual people to postpone consumption, because if they wait rather than consuming now, consuming in the future, they get more real return on their savings. And when you push interest rates down to 0%, you end up with people either feeling that there's more of an equivalence between consuming now and consuming in the future, or they end up pushing their savings into more speculative investments in an attempt to get some sort of return. So I'd also like to get your take on what you think some of the cultural implications are of having interest rates fall so low, and in particular reach that kind of symbolic zero bound. How does it impact the culture?
Well, there's this debate on the question whether the low interest rates are a consequence of increased savings or a consequence of the on the purposeful actions of central banks. I would, or that is our conclusion, that it's more the policy of the central banks which has to be blamed for. And they even stated themselves, I mean, the IMF is now not a central bank, but 2 years ago a paper was published where there was the clear-cut and true statement that zero interest rate is a political choice or monetary policy choice. And I would definitely subscribe to that. And I think it reflects also our current unwillingness to bear the consequences of certain decisions. And you see this in many fields of society, and economic policy is one. I mean, we are not willing to suffer from a recession in order to get rid of the misallocation which has been caused by the boom, but we see it also in different areas. So there are any kind of consequence of action should be socialized, and this will lead, I think, or this will have dramatic consequences on our on society as a whole, because if things go wrong and you're not willing to draw the consequences out of it, so you're unwilling to learn, you are more or less doomed to repeat the same mistake all over again. And in the long run, both on an individual and on the societal basis, this will lead to a downward spiral. I mean, it's kind of this paradoxon. You need to learn in order to improve, even if for some specific individuals or for certain time spans, this will be a burden. And I think this 0% interest environment also is an expression of this unwillingness to accept the burden or the burdensome consequences of wrong decisions. And basically, central banks since 2007 do nothing else. And whenever there is a minor deterioration in economic data, they inflate the money supply ever more. I mean, that's a perfect reflection of this problematic mindset.
So do you think that there's any sort of limit to how far that can go? Because some people say that the system as it stands is unsustainable. Some people say that we're just living in strange times, and as long as we give central banks the right flexibility to maintain inflation at the right level, which would include maintaining 0% interest rates or even pushing interest rates into the negative territory, then we'll end up recovering more quickly and we'll have real economic growth, which will allow us to reduce some of the debts that we've accrued. What's your take on how things are going to pan out? Do you think there is something quite fundamental that's going to change about the system in the next few years? Or do you think we're going to muddle through and be able to find a solution that will maintain the existing financial system broadly as it is today?
I would say that since the collapse of the interbanking market in August 2007, we are in a transition period. So monetary policy does not work according to the textbook anymore. And we see basically that central banks more or less only act on an ad hoc basis. I mean, it was also the case before the corona pandemic. Many things are in transition. I think that what happens every, whatever, 30, 40 years, that's quite normal in that sense. So I would expect in the next 10 to 15 years that a kind of new normal will develop, but don't ask me how this new normal will look like. We have, so what are the main developments? We have on the money side, in a narrow sense, the probable introduction of central bank digital currencies, which could change monetary policy or completely, or will lead or will pose a lot of questions to monetary policy. For example, with a central bank digital currency, of course, you could implement very low negative interest rates. The question is whether the central banks or a society as a whole want to go down this road. We have, and Charles Goodhart is pointing this out in his new book, a massive demographic change which will materialize in the coming years. So this will have a massive influence on economic policy and monetary policy. I mean, many indicators we were using for the last 200 years or so will lose importance. For example, GDP as a whole will shrink, which not because there are fewer people, quite likely, or fewer productive people. The question is whether GDP per head will shrink as well. So I think we will see also a change in which economic indicators we will use, simply because of demographic change. Charles Goodhart was also, or has the fear, or has the hypothesis that globalization has come to an end. So there will be less trade in future, which will put an upward pressure on inflation. On the other hand, you have Africa, which is still not part of the global economy. So this would have, again, the same effect as including Eastern Europe and China into the global economy. So we will see how this will work out. So I think that this transition period, will take at least 10 more years. And if you study, for example, the 70s, the same thing happens. You had the end, the ultimate end of the gold standard. Then the world was going on a system of flexible exchange rates, and you had the elite then was not used to deal with flexible exchange rates because they were brought up in an age of the gold standard, or the last phase of the gold standard. And this is the same thing which will happen now. And we will get the new generation, which will come into the leading positions in central banks and in governments. They have not experienced inflation, because those people now in charge of central banks, they still have been grown up or experienced the high inflation periods of the 70s, which has had massive influence on their thinking. So they are always afraid of that inflation will go out of hand. But those now being 30 or 40, they know it from the textbooks, but they don't have a real world experience of inflation. So this will also change the narratives, of course. And I'm afraid that the danger of inflation getting out of hand is underestimated. And thus I would expect that inflation will be higher in the coming 10 to 15 years than in the last 10 to 15 years. But of course, it cannot be much lower, especially in the Eurozone, than it was in the last 10 to 15 years.
One of the things you reference in the book regarding this change of the financial system is what you outlined a few different scenarios. And I know you said that you don't want to be pinned down on which one of those exactly you think will play out. Obviously, there are a lot of unknowns in that scenario. And you reference gold a lot. I know that you're a big fan of gold, and you think that gold will potentially play an important role in a new monetary system. There's also reference in the book to Bitcoin, which is this kind of emerging digital asset, which many people think will start to play a more important role in international trade. Do you have a view on what you think might happen with the future of Bitcoin?
I have to say I'm a little bit more skeptical towards Bitcoin and the other cryptocurrencies as my two fellow co-authors. I think that Bitcoin can play a role as a store of value, a volatile store of value, can be of avail for workers who work in a third country and want to send purchasing power, put it that way, to the rest of the family, so their remittances to the rest of the family. And I expect central bank digital currencies to, at least for the most part of society, to become the digital currency they will use. Simply because trust is a very important issue, a very important aspect when it comes to money, or when it comes to financial questions. And as long as central banks are a trustworthy institution in the eyes of the population, they have a massive advantage compared to cryptocurrencies, which will play their part. But I don't think that, let's say, 80 or 90% of the population will use one single cryptocurrency. But I have to say, I'm on all these issues a very conservative person, so maybe it's more me being not able to grasp the advantages. So I'm more keen to see the positive aspects of existing institutions and not the chances of emerging institutions.
Great. Okay, well, thanks so much for taking the time to have the conversation today, Gregor. For people that want to find out more about you and your work, what would be the best place for them to find out more information?
I have a website, so the easiest thing is to Google my name. There you can find my latest publications, but usually I publish in German. So for the English-speaking world, that might be a challenge, but that's the best place to find information about my work.
Okay, fantastic. Well, thanks again, Gregor. It was a great conversation. This is the final part of the three-part series that I've been creating on this book, The Zero Interest Trap. It's a fascinating book which deals with all kinds of aspects of 0% interest rates, including some of the things I've discussed with Gregor today relating to the European system. So I highly recommend you go out and check out the book. And if you've got any thoughts on it, please leave them in the comments below this video. We'd really like to see what you think about the general thesis laid out in the book. Okay, well, thanks very much. Thanks again, Gregor, and take care.
Bye.
Bye-bye.